The Bank of England has cut interest rates to 3.75%, dragging the cost of borrowing down to its lowest level since February 2023. Chancellor Rachel Reeves wasted no time calling this good news for families and businesses. And on the surface, it feels like the suffocating grip on our wallets is finally loosening. But before you rush to remortgage or book that holiday, we need to look behind the curtain, because this wasn't a victory lap. It was a rescue mission for a stalling engine. To understand the real danger, we have to look at the vote itself. This was not a unanimous decision. It was a razor-thin 5-4 split. Nearly half of the country's top economists were terrified to cut rates today. Why were they so hesitant to give us the relief we desperately need? Governor Andrew Bailey gave us a clue with a very specific warning. He said that with every cut they make, the next step becomes a closer call. They know that cutting rates is like pouring high-octane fuel into a car. Pouring too much and the engine overheats, causing inflation to explode again. But if you don't pour enough and the car stalls, completely leaving us stranded, and that is the terrifying reality buried in today's report. The bank now expects absolutely zero economic growth by the end of this year. Zero growth means businesses aren't expanding and wages aren't rising. It means the pie isn't getting any bigger. We are just fighting over the crumbs. So the bank had to choose between high mortgage costs or a recession. They didn't cut rates because the economy is healthy. They cut them because it is sick. Let's simulate what this actually does to your bank account this month. Meet Liam. He's on a variable rate mortgage of £300,000. The 0.25% cut saves him roughly £40 a month. It helps, but it hardly makes a dent in the 50% rise in food prices. Now look at John, who relies on his lifetime savings to pay energy bills. For him, this news is a pay cut, reducing the interest income he lives on. Banks are always quick to pass on cuts to savers, but slow to help borrowers. So we have a situation where the young get a tiny break and the old get a penalty. But the real pain isn't what happens today, it's what happens next. Markets are pricing in a gradual path downward, but don't be fooled. We are not going back to the era of near-zero interest rates. Global trade tensions and energy prices mean inflation is still lurking. If the bank cuts too fast and inflation spikes, they will have to reverse course. Imagine the chaos if rates go down today, only to shoot back up next year. This uncertainty is the poison that keeps the economy flatlining. This brings us to the uncomfortable truth no politician wants to admit. Our economy has become chemically dependent on cheap debt to survive. We built a housing market and a service sector that crumbles when money costs real money while we obsess over interest rates. We are ignoring the lack of productivity. We are speculating on houses instead of investing in industries that create wealth. So as the headlines celebrate this rate cut, take a moment to reflect. Are we celebrating a cure or just a slightly stronger painkiller? A rate cut in a zero-growth economy is a warning flare, not a victory parade. The era of easy money is gone, and the era of volatility is here. Food for thought. Are you building a lifeboat or just waiting for the tide to turn back? Don't rely on luck. Rely on knowledge. Subscribe to Stickman Money School to navigate the storm.